Hey guys, Freaky Finance here. Last week we looked at Vail. Will be different again from this week where we're looking at a REIT. So just to update on Vail, the Brazilian exports were flagged to be pretty high in September. So that further validates the position that Vail's Q3 should be pretty good relative to Q2 and Q1. So I'll have to see how the numbers come in, but it's an exciting prospect, and hope you guys got filled last week. You're up a little bit already. Anyway, today we're going to look at Slate Grocery REIT. That was previously named Slate Retail REIT. So they've changed their kind of marketing to focus on the grocery part of the business. It does say that all its properties are 100% grocery anchored. You can see most of their properties are on the East Coast of the United States. It's listed both in the United States and Canada. So what a grocery anchored REIT means is that it has a grocery anchor, so a big store that's a grocery store, and then it'll have all these little ones beside it. So what I mean by that is you can see Publix here, that's the grocery anchor, and then you have all these other random stores associated with the same building, right? And so this landlord collects rent from all these tenants. So while the focus is the grocery anchor, they also collect rent from all these other tenants. So it's a fairly interesting business model. One of the main reasons why they're trying to focus or market that they're such a big grocery exposure is because grocery stores are doing well, right? As restaurants close, everyone's going to grocery stores. And so what happened during the March panic is that this stock went, I want to say, from like 13 to 5. And then they said, no, wait, we're really grocery REIT, not retail REIT. And then it went back up. So right now, the year to date, the REIT is down about 18% versus other REITs, perhaps similar exposure, that are down in the 30s to 40%. So I think its marketing of the grocery chain aspect has worked for the company. Props to them for doing that for current shareholders, but for me looking from the outside, it's like, oh, kind of missed a little bit of the panic in March to jump into this one. So with properties, this is a pretty good way to break down the square footage per state. They're fairly heavy into Florida and Pennsylvania and North Carolina. So those are the three primary exposures, but you can see it's fairly diversified across all of them. Just for context, the one that I pulled up is to show you that Publix mall, that was Oak Hill Village in Jacksonville. That's the one I just picked on. And they have the occupancy for each of them and which ones are vacant. And they have the primary grocery 10 or anchor. Quite a bit of exposure to Kroger and Publix, but that's kind of what you want. That's why I was looking at the company. And Walmart as well. So fairly diversified across the different states. However, when I first looked at the slide presentation deck, I almost felt like almost all the revenue was from grocery anchors, right? The 100% grocery anchor. And so I'm like, oh, that's exciting. And then I click into it, and so the rent is kind of broken down. So yes, a lot of the rent is from groceries and supermarkets, but some of it's not. So 12% restaurants, 4% fitness facilities, and that's kind of the weaker of the ones up here. And then what does other necessity-based daily needs really mean, right? But overall, it's a strong portfolio, and they market it as such, right? So the rent collections, they're saying that they collect quite a lot of their rent, right, relative to other REITs, but other REITs have also rebounded quite a bit. It's always challenging to get out of your business-to-business leases. They generally always tend to be sticky until the lease expires, and they can just walk away from the lease, right? So they have started to come back like most other REITs have, and their cash collections were never that low. So 86% might seem like a lot, and it is for a month, but that was the worst month, right? That was April. And then by May, we started having the effect of the stimulus show up in the economy. So we will see what happens if the stimulus doesn't go through, right? I would venture that these non-grocery tenants would stop paying, or at least require PPP again to pay rent. So the cash collections have been quite high. There is some deferrals, and we're going to see that when we jump into financials. So we'll do that now. The annual, just to see what the company is capable of and what it's been doing. So in 2019, they sold some properties. So you're going to notice the revenue decline. And most people panic when they see revenue declining, but if they're selling the properties to generate the revenue, it makes sense, right? That by itself isn't an issue for me, but when I have declining revenues with lower properties, then I'm like, okay, that means operating expenses should be lower, but they actually went higher, so that means technically from a management standpoint, they underperformed the prior year, and the GMD reflects that, right? They have $4 million less in GMD from both the less properties and not cutting expenses at the same rate, and a part of that will probably be negative scale, right? You can scale your business better if you have more properties, you have the same kind of costs. So operating income is down $5 million, about 10%. However, you'll notice the net income is very fluctuating. So when REITs have this interesting thing where they have to market their properties. So basically, they take recent transactions that are in the area for their given property and say if it's going up or down, they have to mark the properties up or down, and it flows through the profit or the income statement. Sorry, that's how that works, and it can be very volatile. So in 2018, they had a $66 million write down basically in property value. Then in 2019, they had a $1.5 million write down. So it's very volatile. It's a delta of $65 million, right? So you see the bottom line is nuts, right? From a volatility standpoint. So that's why you can't value REITs on their net income. You have to value them on their cash flow. And specifically, most people would use FFO and AFFO, which is just funds from operations. And then AFO is adjusted funds from operations. And the difference between the two is AFFO basically just takes out the maintenance part of the expenses. So any additional expenses earned to generate the income. That's basically how I translate that. We can actually see that despite the decline in revenue and the decline in margin, the share price actually went up in 2019. So from my perspective, it got more expensive in 2019. The debt's a little bit better because they sold the assets, and when they have the assets, so REITs are structured so that they take on a bunch of debt, usually sometimes half debt, sometimes 2/3 debt, and they acquire properties, and then they slowly pay the mortgages down over time while the tenant pays the rent, right? That they charge, and they make the spread between what they can borrow from the bank versus what they can charge the tenant, and that their expenses for operating the property. So it's a pretty decent model. Like if we look here, just to break it down, they're able to generate $141 million, but they only had to incur $51 million in costs, right? So they made basically $90 million, but then they got to pay the people that they borrowed from in order that they used to acquire the properties, right? So you can see $37 million went to their lenders. Their net was 52, which isn't bad on $141 million, right? They're still getting a third. And then most importantly for shareholders is that you're holding this for the dividend. So what REITs have to do by their very structure is that they have to pay a large percent, usually about 90% or more, of their net income, as their cash flow, as a dividend. So you can see here their CFO for 2019 was $44.4 million, and their unit distributions were pretty much the bulk of that. That's $36 million, right? So the net there is only $8 million that they didn't pay out in dividends. So REITs, by their very nature, don't keep very much of the cash they generate. They give it to the shareholders. And that's why REITs have traditionally been very good investments over time. One of the things that's unique to a Slate is I mentioned they've been disposing assets during this period, anyway, from 2018 to 2019. You can see they use some of the proceeds to also repurchase the unit count. So kind of like shares outstanding, they have unit count outstanding. For our purposes, it's the same thing. And you can see it went down by about 1 million in the unit count, right? So their assets went down, their liabilities went down, and their unit count went down. From an FFO and AFFO perspective, it looks pretty sound. I always check on REITs to see if the FFO matches close to what the GMD is doing, just because I view those things almost, they should be very similar unless there's some weird accounting adjustments. And there could be some one-off noises that make sense, but it's always my safe check. The FFO will usually always be lower, should always be lower than the FFO. And like I said, that's more of just any extra maintenance cost incurred to run the property. So like I said, the share price from an FFO perspective is slightly more expensive in 2019. From an AFFO perspective, it's been steady. The debt to book value is 60%. So the REIT does have a covenant on it, and most REITs will have this covenant. So basically, the lenders will allow up to 65% debt to the total book value of the assets. So one of the things to look at in a declining property environment, not that this is subject to that, but some REITs are, and it's always something to keep in the back of your head, is if the assets are marked down, then technically this ratio goes up. Say if all of a sudden these grocery malls all over that eastern seaboard of the US, all of a sudden all of them are all of a sudden 5% worth less, or 10% less, you're going to see that ratio start coming under pressure, right? And then the lenders are going to be like, what do we do? Do we just relax the covenant, or do we actually decide to take over the properties? Most of the lenders don't actually like to take over the properties. Some specialize in taking over assets, but most lenders to REITs aren't interested in running the REIT themselves. They're just interested in collecting the interest that they get from the REIT, right? Just like shareholders would be interested in collecting the dividends from the REIT. It's always a risk, so I want to bring it up, especially because it is at 60%, whereas some other REITs that would be competing for your capital would be in like the 50% range. The occupancy has been trending down, so that's another thing going against it. And that trend did continue in Q1 and Q2 of 2020 as well. We're going to jump into that right now. So on the more recent quarterly information, again, the revenue went down and the properties went from 83 properties to 77 properties. It actually dipped lower during Q1, and they recently made some acquisitions in June of Q2. So it's hard to go apples to apples here on the top line because the property positions have changed somewhat. So we'll have to see what Q3 brings to help factor out the noise here. When you see GMD down another 4 million year over year, you got to take into account they had less properties generating revenue. And this time, at least, I see property operating expenses declining, which is good. I wouldn't want to see this steady again, or actually increasing like I did year over year in 2019, right? So you have less than 3 million less in operating income. More importantly, if I jump down to the CFO, you can see that we had 2.4 million less in CFO. And the share price did reflect, like I said, it kind of panicked during Q2. In March, like most things, this thing tanked. And then they kind of said, no, we're a grocery REIT. We're not just a retail REIT. Well, our properties have 100% exposure to groceries because groceries are seen to be safer, right? And they've been performing very well. It's the Albertsons videos I did in the past. The stock is technically cheaper than it has been in the past, but the cash flows have also decreased. One of the important things to keep in the back of your head is that when I look at the deferral part, I broke out aged AR here for a reason. And you can see that there's $12.9 million in AR at the end of Q2 versus prior year. And this is about the average. So AR is starting to increase. And more importantly, the aged AR is beginning to increase. And the bad debt expense in the AFTA has barely increased. So you'd expect these things to correlate with each other on deferrals. So right now, the company is still expecting their tenants to pay their deferred rent that they haven't collected. When I mean deferred, obviously it's showing up in AR, which means they would have booked it in revenue. What that means is it could be an adjustment down the road if they don't collect, or they have to write off some of this AR that they're not actually going to generate the revenue, right? And that depends on the tenants. So that's why I wanted to show you that one mall where you can see, yes, it has the grocery exposure, but it has a lot of random exposure associated with that strip mall, right? It's something to keep in your back of your head, because it is marketed like a grocery REIT, but I don't think people actually clicked on the properties to see what exactly was there for every 77 properties, right? I just bring that up because, well, the thing is down 18%, other REITs with similar exposures are down much more than that. So is it cheaper based on cash flow? Technically it is. Not as cheap as it was back in 2018. The debt to GBV stayed about the same, and so that's interesting as well. So a lot of other REITs have impaired their assets, which have shot up this ratio. And this one hasn't yet increased its impairment. So basically it's saying our assets are not impaired yet. We're still collecting our money. Our tenants have no problems, right? That's kind of what the conference call sounded like. Whereas other REITs have been a little bit more, I don't want to say conservative or realistic or what, but it just shows that they have been slightly more, I want to say aggressive, but it's not really aggressive. They just believe that they're better or not challenged by COVID like other REITs are. I do want to point out here that you can see the CFO starting to decline. However, the unit distributions have not. Q3, technically, because they acquired assets at the end of June, or beginning of June, sorry, should technically increase the CFO and the FFO therein, right? So it should alleviate some of this pressure, but I just want to point out that the $10.3 million in CFO, you can see unit distributions were still $8.85 million, right? So they're pretty much paying all their cash flow from operations into distributions to shareholders. And so while that sounds good on paper, you gotta keep in the back of your head, make sure that's sustainable, right? You never want the net distributions to be higher than the cash flow, because that's not sustainable by definition. They'd have to borrow to pay you. So right now the dividend yield is amazing, right? 10.7. That's another thing that attracted me to the company, right? I said, oh, grocery 10.7 yield, let's check it out. If I just had this 204%, so all I did there was just go 7 years at that dividend yield, you pretty much double your money, right? The 18% discount that it currently has from prior year doesn't even have to close. So that's something to keep in your back of your head for the REITs. You make a lot of your return from the dividend yield, and 10% is no small thing in a low return world, right? So it has some good things going for it. The grocery anchors have a longer lease term than other tenants that have shorter lease terms. So when I jump back into here, how it kind of shakes out is you notice the grocery rent per square foot is generally a bit cheaper. So you got $8.30. It has been, technically that's a high, going back that many quarters, 8 quarters, so fairly decent. And then you also have shop space rent, which is also at a high. And then I'm like, okay, what's going on here? And so this trend right here is very useful, and you can see the gap between the in-place rent that the company has with its tenants on average versus what the market rate is estimated. And so what tends to happen during a recession is that the rents either flatline or decline, right? Q1 had that effect. Q2 looks like it's bouncing a little with less stimulus coming in, or delayed stimulus. We'll see if this dips down again. Usually there's this lag, so you can see how the companies technically most companies will always say they're under what the current rent marketplace is. And when the spread narrows, I say, oh, that's good for margins, right? They're increasing because as the leases reset every 5 years or so, then they have the opportunity to increase the rent to the current market price, right? And so there's always like a lag. But when this lag closes, I'd say, okay, in the future, is this rent going to start decreasing, and therefore I'm going to make less cash flow? And that usually puts pressure, both then the company has to think about impairments, and then from the actual cash flow as well. So did the rent slowly start flatlining out for growth? Does it actually decrease? We'll have to see what happens. I mean, the grocery stores aren't the problem here. It is the associated stores, but it has a lot of strength because it has that center anchor to the grocery store. So if people go to the grocery store, they might go to the other stores around it, assuming those stores still exist and then are open. So it's an interesting thing to keep in the back of your head. It's one of those reasons why REITs usually outperform over time, and if inflation picks up, rents usually pick up, which means their spreads slowly pick up. So REITs generally do okay in inflation, especially in a low interest rate environment, so they can borrow at the bank very low, and then they can pass through the inflation through the rent over time, and then the property values usually inflate as well, right? So inflation's not that bad, deflation would be. So there's always that risk. And stagflation, we'll have to see. We'll have to really see what the government policy is going forward here. This is just their fact sheet. I think I touched on all these things already in my own way. I wrote down, but I didn't bring up the AFO payout ratio. So the payout ratios are basically just another way to see how secure the dividend is. So whenever it's over 100%, that's your first warning sign to watch it. So you can see in Q2 it actually did hit over 100%. So that means the shareholders received 100% of the AFFO, the distributions were equal to 100% of the AFFO, and that's not sustainable in the long run. Something to keep in the back of your head. Usually if it persists, then there's usually a dividend cut. Like I said, the company acquired some properties at the beginning of June, so that should alleviate the pressure, but we'll have to see. Overall, it's a fairly strong company, and it markets its way. That it's like, we're a grocery, and honestly, their slide deck, it was all Publix, Kroger's, Walmart. There was none of that Planet Fitness, nail salon, Little Caesars, right? It was all the primary big grocery stores, and other REITs will list like their top 25 tenants. This one listed the top 5, and they're all grocery stores, right? So kind of funny from a marketing standpoint, and I think that's being sold to investors, and that's why the REIT has outperformed other retail REITs that have at least somewhat similar exposure. I mean, a lot of the REITs won't have 100% of their properties with a grocery anchor, and that's what this one has. But a lot of the REITs will have similar revenue from grocery stores, right, as a percent of total revenue. So it's slightly, I think they're trying to increase the share price. So that's their job. So I can't fault them for that. But for me looking in, I'm like, I wish this was cheaper. So anyway, from an AR perspective, I just want to bring up a lot of other REITs have put in either bad debt expense or allowed AFTA to increase. AFTA usually always increases, AR increases, and they've done that here. So it's up $200,000, which is pretty much immaterial. But I do want to point out here, the aged AR went from 2.8 to 7.1 million. While their AR looks the same, it's not the same. And that's the deferral part. Something to keep in your back of your head. This could be a bad debt expense waiting to happen. Might not be a huge blow, but in the quarter that happens, it could be an opportunity to buy it. So that's what I'm thinking of. On the REITs, I already touched about that it has to be under 65% debt to equity. Debt to the gross book value of the assets. The minimum fixed charge is slowly trending down, but right now it's not an issue at this time. But it is also another thing to keep in your back of your head, right? So these are covenants with with the debt, or on their debt, just to see the maturity schedule. It's fairly well staggered. Their next big debt is 2023 for $250 million. So they'll probably have to be rolled over given the cash flows and the fact that REITs actually can't hold cash, right? They have to give it all to their unit holders based on the definition of the REIT. Something to keep in your back of your head though is there's, like I said, 60% of is debt right now versus the asset value. The effective tax rate's pretty low, 3.96. It's 100% fixed, so it won't go down with interest rates already at their lows. So that's probably going to be where it stays unless it revolves this at a lower rate, which could be possible. The thing I do want to point out here is that their interest expense actually increases when they get between certain percentage of debt to the asset value. Well, you might not be able to make it out, but basically in every 5% bracket, they incur more interest charges. So they'll incur higher interest charge between 60 to 65 debt to book value of the assets, and then 55 to 60% of the book value of the assets, and then again in 5% increments like that. So they are incentivized to reduce their debt over time. We'll have to see if they do it. Most will target the mid 50s, I'd say, over time as the REIT gets older and more mature. On the call, the earnings call transcript from Q2, the only thing interesting here, I'll just bring that up a little. You can see that they do talk about how 6% of their tenants received the PPP program. That's something to keep in your back of your head. As stimulus slows down, their cash flows will become impaired because their tenants relied on PPP to pay them. I mean, it's only 6%, not the end of the world, but on top of the deferrals they currently have, it could instant like a bad debt expense or something, or some impairment, and then maybe the stock market reacts to that, and then I can have a chance to buy it. Like I've kind of touched on already, it is an interesting company, and it does look fairly stable. I mean, the grocery anchors give it a lot margin of safety, but the market's priced in already. Like this company's less risky than other REITs, right? It's only down 18%, and other REITs that are technically collecting similar amounts are way under that, down 40% or so. So it's an exciting company. If people panic buy or panic sell again, this might be something I push the button on. I'm probably not going to buy it now like I did with Vail, but I'm going to keep my eye on it. It's an interesting idea. The cash flow's there. I mean, the yield's there, 10%, 10.7. Exciting company. I'd like to know your thoughts on it. But yeah, you should check out the deck, and all you see is grocery stores. There's no other tenants.